Hello, my name is Steven and I'm the calculator guy, and today we're going to talk about yield crafting. And what I mean by yield crafting is finding a good yield, a good stable yield, and then crafting that to your desired market exposure, right? If you want to be long, short, or neutral. Because there are ways to do that. There are ways to find a good yield and then change your delta or change your delta exposure in a variety of different ways. So what do I consider a good yield? That's an excellent question, and I'm glad you asked. I consider good yields to be ones that are relatively stable, so you can look at the historical yield rate, and it's plus or minus of a variance of like 10-20%. Additionally, it's one with assets that are unlikely to rug, and it's one with assets that I can definitely borrow or delta neutralize if I have to or if I want to. So after playing with this and strategizing on this theory, what ends up happening is you're looking for L1 stable pairs, right? L1 just means any proprietary coin of a blockchain, so Matic, Phantom, AVAX, Ethereum, Solana, etc., etc., and then a stable coin. So why do those pairs meet the criteria? Well, they're going to consistently generate trading fee revenue because they're the most traded assets on their own proprietary chain, and they are relatively safe assets, right? AVAX, Phantom, BNB, for example. These things aren't going to rug, with the exception of potentially Luna, which had its own very Black Swanish event. But for the most part, L1s are healthy coins. They may experience incredible volatility, but they're not going to go away. So, and you can get easy market exposure on them. So if you wanted to neutralize your delta, if you wanted to effectively benefit potentially from downward price action, you could do that because L1s are always going to be available to borrow on a money market or a borrowing and lending platform on that chain. Okay, so let's just sort of dive right in and sort of walk through a few of the things that you may think about when looking to invest in and start getting yield. I'm on the Binance Smart Chain because it's the second largest chain and you don't have those Ethereum gas fees to worry about, and there are some decent yields available. So on the Binance Smart Chain, I know that I'm probably going to go to Beefy because Beefy will aggregate my yield for me. It will limit my exposure to farm tokens, and they generally do a good job of sussing out the good farms from the suspicious farms. So if we go to BNB and you're looking for BNB stable pair, right? I found this nice one on BabySwap, which has sort of been on the up and up lately. So BNB USDT on BabySwap, I click this because I like the safety rating of 9.4. I zoom out to see how the yield is, and it's relatively stable, hovering around maybe 35%. That's great for me. I like that. So what I could do is I could open up this position as is, right? And then have half long exposure to BNB, half long exposure to USDT. If that's what I wanted to do, right? That would just be basic investing in this particular pool. Now, let's say I want short exposure to this. Let's say I like this strategy, but I don't want to be long exposed to BNB. I'd rather be short exposed to BNB. What can I do? Well, on the Binance Smart Chain, right, we're looking for a borrowing and lending platform. We see that Venus is the top borrowing and lending platform. So we head over to Venus. We would collateralize some stablecoin, USDT maybe, DAI maybe, for a higher interest rate. So we're getting paid 3%, 2.5%, sorry, and then we're paying 1.2%. So we're actually making money just on this to borrow BNB. I usually go with 50% LTV, but your own risk exposure is up to you. So collateralize stable, borrow volatile, bring that over here, and then enter the position with your BNB. So what happens then, right? That BNB splits into BNB and USDT. So half of the BNB is sold for USDT, effectively shorting half the position. So now you have half of this LP as short exposure. As BNB decreases in value, that USDT will buy more of it. And when you exit the position, you'll have a surplus of BNB. So when you return your debt, you'll actually have extra BNB to sell and actualize as profit. So if BNB goes down, you benefit from that. You are now short farming. Congratulations. You have negative delta exposure. and that's a good thing in bear markets. But all I'm trying to do is show you what you can do with these opportunities, right? So again, what I search for is L1 stable pairs, and then I make my own big boy decisions about what kind of exposure I want to that, whether it be long, short, or neutral. Okay, so let's hop over to Alpaca to sort of notch this up another notch, as that chef on Futurama would say. What was his name? Bam! It was like a knockoff of Emeril Lagasse. Anyways, I'm looking again for stable BNB. I see one for USDC BNB at 74%. I see one for... Is that it? Really? BNB. BNB USDT on Buyswap 64%. BNB USDT on PancakeSwap 106%. So I might go with the PancakeSwap one because it's the highest. But what you want to do first is look at their historical yields. So how would you do that? You could do it on CoinDex. It's going to be a bit hard. You could do it on APY Vision if you have that. I might do it just on Beefy because it's pretty simple. So what if I'm looking at Buyswap or PancakeSwap, right? So we go over to filters and we're looking for Buyswap and we looking for BNB. So Buyswap has a bunch. USDT BNB 10%. So that leverage up is probably not going to give us 60%. Especially if it's only leveraged 3x. If we sort it by APY, it makes me, okay, so here's USDC BNB. This is the one they're looking at, 20%. 20% leverage 3 times, could be around 60, so that seems good. How consistent is this yield? Looks pretty consistent. I'm sold. I like this. I think that this one would be a good bet. But let's say if I want to do the BNB USDT, so that's on PancakeSwap. I want to see how consistent that one is. Back to filters, back here. Now we're looking for PancakeSwap. There we go. Looking now for BNB USDT. And here we go, 19%. So I think that the advertised Alpaca yield is unrealistically high. So I may not enter this one. Maybe I go with the Buyswap instead because this seems to be more accurate as per the advertised APY on Beefy. Okay, so that's what I would do, right? And now if I want to change my delta and play with my delta a bit, whether I want to be short, long, or neutral, really you can only be short or long using Alpaca basic leverage farming. If you want to do their neutral vaults, that's up to you. They have mixed performance. So if you want to enter with either of these, totally up to you, or a little bit of both. If you enter with both, cool, you start off with 50-50 long exposure on either. If you want to be super long on BNB, you can enter with BNB and then borrow USDT. What that does is effectively shorts USDT in favor of BNB or leverages you up with BNB exposure. If you click the simulator, you'll see you do really well when BNB goes up and you do really bad if BNB goes down. Conversely, you could borrow BNB and now you have more short exposure, and so your strategy actually benefits from BNB going down until a point, and then it sort of quickly tanks. Now there's a way to hedge even this risk, and that would be by using a borrowing and lending platform like Venus to enter the position with borrowed BNB, so anything on this side is actually profitable for you. Because as you tank this way, what you're doing is you're accumulating much more BNB in that LP, so when you exit, you'll have a ton of BNB surplus to sell as profit when you go return your borrow. Okay, I know that was a lot. Again, all I'm saying is search for these L1 stable pairs, and then you can determine what kind of delta exposure you want. Right? I'm not going to tell you what kind of delta exposure to have. I'm just showing you the opportunities. One of the best chains for L1 stable yields is Solana. I'm not going to tell you what the best chain is because, you know, I need to offer something to the Patreon and paid Discord members, but one of them is definitely Solana, right? So this is Solana with leverage. Do keep that in mind. And when we're looking at Solana with leverage, you're looking for around 180%. What you can do, or 140%, between 100 and 180%, I guess is reasonable. A lot of swap fees going on. Great for these farms. What you can do is you can enter these long, short, or pseudo delta neutral without any money market. and you're going to run into the same sort of exposure things. Oh look, I'm up 3.3 Solana. Yay me! I'm short though, so all of that any excess Solana is profit for me. Okay, so if you're entering the position and you want long exposure, same thing, right? You're going to enter with Solana, leverage up, you're going to borrow all USDC. On the simulator, you can see that, what's going on here? Oh, sorry, you're going to borrow all USDC, which means you want to be over here. Yeah, so this way, now you're borrowing all the USDC. So if you're borrowing all USDC, you have super long exposure, leveraged long exposure. As Solana goes up, you are doing very, very well. Congratulations, you. Right, Solana goes up 46%. Your equity goes up 100. Well, it goes up 40%. So that's really good, right? Leveraged positive exposure, and you're getting LP rewards. Awesome. This is something you want to do in a bull market, not in a bear market. If you're very bearish, what you might do is the opposite of that. You borrow all Solana against your Solana. In this case, you're going to benefit when Solana goes down up to a certain point right around here, and then you go negative. Again, the way to hedge that risk would be either through perpetuals or by neutralizing this on a money market. So collateralizing USDC, DAI, or something on some sort of borrowing lending platform, and then taking that Solana that you borrow against it over here and entering. In which case, everything on this side would be profitable. So I need to reiterate, what I'm showing you is simply how to find interesting strategies and then how to make them fit your market exposure preference. If you want to be long, short, super short, or if you want to be relatively delta neutral, what you could do is enter with USDC. Let's delete this, because you don't want to be exposed to Solana, holding it, and then borrow 25% USDC, 75% Solana. Why these ratios? Well, you're at 3x leverage, which means you're $1,000. You're trying to get a yield on $3,000. So you're entering with 1, you want to get a yield on 3, that's 3x leverage. So you need to borrow $2,000 worth of assets, right? If you're borrowing $500 USDC, that gives you $1,500 USDC total. And you remember, you're trying to get $3,000 yield, so you have $1,500 of Solana that you need. Well, that's going to be perfect for an LP where you need 50-50 split. And if you're just borrowing the Solana without selling any of it, then you're not shorting any Solana. You're not longing it, but you're not shorting it either. So you're neutral on that Solana. You've borrowed 500 USDC, so now you have your 1,500 USDC and $1,500 worth of Solana that you're just borrowing. So you're neutral on it. You just have to return it when you're done. And the only way to lose here is through impermanent loss, right? So if you enter this, what you'll see, so we have a nice sort of broad curve here. To get a 10% loss on your equity, Solana has to go down by 51%. That's great. If I'm getting 140% yield on that, and Solana has to tank by 50% in order for me to take a 10% hit, I'm okay, right? I'm happy. Likewise, it has to go up by 60% for me to experience an 8% loss. So I'm happy there too. This is a nice pseudo delta neutral strategy, decent yields for the sort of moderate man who wants to go in and get some exposure to yields, right? Okay, so you have short, long, super short, and then super long options here, which I really like. You also have the option to set up stop losses if you want to prevent liquidation. See, stop loss set up, you get kicked out before liquidation. Okay, so again, the theory here is that you are seeking out yields on L1s plus USDC. Now, those are not easy. I mean, they're not difficult to find, but they're not super intuitive to find if you're looking on Beefy. Like, let's say you want to search for Matic. You would type in Matic. You would presumably go to the Polygon chain, clear these, and you would have to then, like, go and oh, sorry. I thought this was Matic X for a second. You'd have to then scroll down and find one like Matic USDC, and then you'd have to go into ApeSwap and check the historical yields, which are a bit dicey, right? They've gone down 20%. It's not too hard, but you have to aggregate those yourselves. If you are a Patreon member, then I've done most of this work for you. I found a lot of these blue chip stable LPs that you can play around with. Again, you determine your kind of exposure. We've also compiled a list of leverage yield farms. I'll let you guys see this because Beefy doesn't have this, and I wish they did. But since Beefy doesn't have it, or not Beefy, since DeFi Llama doesn't have it, I'll provide it for you. Shout out to the intern who put this together, Evolution, if you are in the Discord. That's him. Or her, I don't know. And there you go. So these are all of the leverage yield farms that we found. I will say that Mesh Swap rewards in proprietary token. I don't like that, so that's not really my preference. So here you go. You can look at them, get an idea, and then some of the future ones that are coming out. So if you want to go out with these L1 stable yields and sort of leverage them up or change your delta risk, here's a few of these places you can do it on all of these different chains. I hope you enjoyed this video. I hope that you got an idea for how you can go out into the world of DeFi and still get yields, and not only get yields, but cater them to your preference for delta exposure. One last thing to consider is that if you would prefer to not use a money market, what you can do is open up a perpetual or a short position against your long exposure. So let's say you were in Beefy, and well, I could tell you one of my secrets, but I'll say that for another time. Let's say that you wanted to neutralize your Matic exposure here, right? So you're entering this position with $500 Matic, $500 USDT. So what you might do is open up a Matic short position with 2x leverage, so of $250, because $250, 2x, is effectively being short on $500 of Matic. So then, right, if Matic goes down, you're gaining more Matic in the LP, but your short value is increasing. So you're basically delta hedged, except you have to rebalance every once in a while to really hedge to be accurately delta neutral. The benefit of doing this, the benefit of going over to KuCoin, going into futures, and opening up these perpetual derivatives, opening up these perps or futes, is that it takes less initial capital, so it's more capital efficient, but it is higher risk, right? There are liquidation risks, and you have to know where those are. If you don't know where those are, don't do this, right? Absolutely don't do this. But Matic, for example, Matic perpetual, right? We would be selling shorts. We would want 2x leverage. You could do whatever leverage you wanted, as long as you had plenty of money in there to give you a buffer. And it would be trading unit, switch to can't do 25%. Well, and then you'd want to do whatever $250 worth of Matic was there. You would sell as perpetual, probably put some stop losses, things like that, to boot you out whenever you need to be booted out without liquidation. And that's it. You would have your risk hedged that way. I am going to build a calculator for this particular type of delta hedging, but at the end of the day, all I want you guys to know is that you don't have to have long exposure to have access to farm yields. Go join the free portion of the Discord. Support me and Mi Familia by joining the Patreon. I do think we're going to start giving maybe some more benefits to the lowest tier, $10 tier patrons. And yeah, if you have any questions, leave them down below. Thank you so much. Have a wonderful rest of your day. Okay, I'll show you one more thing. One more sort of interesting thing you can do is get a neutral, delta neutral yield, like real delta neutral, not pseudo delta neutral yield, by neutralizing your exposure to a single side LP. So Matic X Matic is not going to experience impermanent loss, or at least not any meaningful permanent loss. Matic X is a yield aggregating wrapped form of Matic that has a redemption model, which is really important that it has that, because that's going to help maintain peg more than something like staked ETH that didn't have a redemption model in place until ETH 2.0. So Matic X Matic, it gets around 15% yield, right? And if you don't want exposure to Matic, maybe you do, Matic's doing pretty well right now, but if you don't want any exposure to Matic, any long exposure, you can neutralize this with a perpetual or with a money market. So you could collateralize USDC or USDT, borrow Matic, enter this position with that Matic, and then when you're done getting the yield, just return the Matic, right? And then you get to keep all of the yield. Now, do consider interest you're paying on that Matic as borrowing. Same thing with, to be more capital efficient, you can do this with the shorts, right? So let's say you open up a $100 position with Matic x Matic. You could then 2x short or 3x short, $33 or $50 on KuCoin, and just leave that short position open to neutralize your exposure. Matic goes down, then your short goes up by the exact amount that Matic goes down, or at least the value goes up by that much. And if Matic goes up, well, then your position goes down, but you're still neutral, right? You still have a neutral exposure. You do have to pay interest on the perpetual, but it's not going to be very high. So, and you can do this with like S Phantom, Matic X, SAVAX, all these things. Anything you're getting a single side yield on, or effectively a single side yield on, you can neutralize in some way and then just sort of appreciate the yield. Okay, that's it. Thank you guys so much for watching, and have a wonderful rest of your day.